Hello everyone and welcome back. Today we are testing a volume trading strategy. It works on the daily time frame and it is known as a safe strategy, so you have very little risk in theory. I simply called it the volume trading strategy because it uses the volume among other technical indicators. So we're going to write a code to test this strategy automatically over data covering a period of up to 18 years, which would really give us an idea how this strategy is performing. And as usual, for those who are interested in the coding part, you can find the Jupyter Notebook Python file in the description of this video. There's a link where you can download the whole file that we are using for this test. We will use the 200 exponential moving average as the first indicator. If the price is moving below this curve, we will consider we have a downtrend and the opposite is true. So if the candles are above the 200 EMA, in this case we have an uptrend. The first rule is that when we have a downtrend, we're looking only for sell positions, and when we have an uptrend, we're looking only for buy positions. So in this example here, on the left side, we're looking only for sell positions, and on the right side of the graph, we're looking only for buy positions. The second rule is that we're looking for 4 candles going in the opposite direction of the trend. Here, for example, we have 4 consecutive candles retracing the price closer to the moving average, and we need at least 4 candles. So it might be 5 or 6 or even more candles, but we need at least 4 candles. And anyway, the number of candles we consider here is left as a parameter for the user of the code. So in the Jupyter Notebook, we can modify this anytime we'd like, but for now we're sticking with a minimum of 4 candles. Then we're looking at the following candle that should be in the same direction of the trend. So here we have a downtrend, and this particular candle is a bearish candle, and we're going to check the volume at this time after the candle has closed. So at the end of the trading day, if the volume is greater than the volume of the previous candle, in this case we have a sell signal because we are in a downtrend. So again, to recap, for this example, we have a downtrend, we are trading below the 200 EMA, we identified 4 consecutive candles going in the opposite direction of the trend, followed by a bearish candle, which volume is greater than the previous candle's volume. So we decided that this is our selling signal, and in the case of an opposite trend, meaning if we are in an uptrend, we're going to look for at least 4 consecutive bearish candles, followed by a bullish candle, which volume is greater than the previous candle's volume, in which case we have a buying position. Now comes the tricky part: how do we set our stop loss and our take profit? For this video, we're using 2 different ways. We're going to test both methods and check the outcome. We can either use an ATR related stop loss distance, like for example twice the ATR or 3 times the ATR from our selling or buying positions, or we can simply consider in a downtrend, for example, and for a selling position, the highest high among previous few candles. As to how many candles should we look back in order to put our stop loss, this is left as a variable in our Python program, so we can test on it, but I usually start with the same number of candles, meaning 4 candles that I was using to check our trade signals. Of course, if you are looking to an uptrend and a buying position, we're going to look for the lowest low of the previous few candles. Okay, now let's check the code and see how it all worked out. So this is our Jupyter Notebook file. We are starting by importing pandas because we need this. We need the function called read_CSV to load our data, the Euro US dollars daily asking price from 2003 up to 2022. It's a CSV file. I also loaded different data, the Euro US dollar 4 hours charts, some stocks, the Amazon, the eBay, and the Volkswagen stocks, just to try this strategy later on stock market also. And since we are using daily data, we don't have as many rows as we'd like, so it's only 6,858 at first, and it's going to be reduced further when we are doing the cleaning of the candles or the rows where the volume is equal to 0, because these are weekends and bank holidays where the market is not moving, and these are not of interest for our analysis. I'm also changing the columns titles to time, open, high, low, close, and volume. Depending on the file you are loading, the CSV file, these can be sometimes different, and it's better to have them this way. So our program later on is going to understand the titles that we are using for these columns. And then we can use the pandas_technical analysis module, STA. I'm importing this to compute our exponential moving average using the EMA function for 200 length. So it's the 200 EMA, and the ATR for the stop loss and take profit ratios that we are going to use later on. These are added as new columns into our data frame. We have a column called EMA and another column called ATR. Then at this point, we need to compute the EMA signal. Remember that if the candles are trading above the EMA curve, we are in an uptrend. And if we are trading below the EMA curve, it means we are in a downtrend. And here we have written all of this in this cell. So we have a test over each row, each candle. If this particular candle that we are looking at and its previous neighbors, let's say 4 back candles, are trading above the EMA. So I'm not looking at one particular candle if it's above the EMA. I need to have this particular candle above or below the EMA, but also its neighbors, like at least 4 or 5 or even 20 candles that were trading so far above or below the EMA to take a decision if we are in an uptrend or a downtrend. And this is left as a parameter. It's a variable. Here I'm using simply 4 to increase the number of our signals. But if you want to go safer, or if you are using this strategy for a lower time frame, like the hourly time frame, for example, you might want to increase this to around 10. And this would mean if you are using an hourly chart or an hourly time frame, if you put 10, for example, it means that you have 10 back candles, 10 candles that were trading above or below the 200 EMA before you consider that you have an uptrend or a downtrend. In other words, your price is trading above the EMA for 10 hours or below the EMA for 10 hours before you consider your trend. Here we are using the daily charts, so when you say 4 back candles, it means that the price has been trading above the EMA for 4 days or below the EMA for 4 days. And in this case, we are going to assign 2 for an uptrend, 1 for a downtrend, and 3 if you have both. But this is the case where we have an error. It doesn't happen. So I just wanted to print this just to verify that my code is working properly without any bugs. And this signal is stored in a new column in our data frame called the EMA signal. So if it's a 2, then we have a buying signal, we are in an uptrend. If it's 1, we are in a downtrend and we are looking for a selling signal. Then we have the volume signal. Remember that to identify a candle where we are going to buy or sell, meaning we have a buying or selling signal, we need the volume of this particular candle to be higher or greater than the volume of the previous candle. In this case, I'm checking one candle to be compared to the current candle. So I'm comparing the current candle, which is in my current row, let's say, with the previous candle, meaning I took only V back candles equal to 1, meaning volume back candles equal to 1. So here I'm comparing the current candle's volume to the previous candle's volume. We can compare it to 2 previous candles or 3 previous candles. And this was left on purpose in a variable like this, because if you will use it in an hourly time frame or 4 hours time frame, you might want to increase this. Like you need the current volume of the current candle to be greater than the 2 previous volumes of the 2 previous candles. And in this case, you would put number 2 here. And again, as we have done for the EMA signal in the previous cell, we are going to store this volume signal in our new column in our data frame, which is called V signal in this case. Remember, this is only a test to check if the current candle has a greater volume than the previous candle, in which case we are returning 1, otherwise we return 0 as a signal. Then we have the price signal. So we're looking for 4 different candles that are going in the opposite direction of the trend, and this is done in this particular cell here. So I also left this P back candles as a variable for us to change. If you want to have more tight or more strict signaling, you can check this, you can increase this to 5 or 6. So in this case, the program will be looking for 6 consecutive candles going in the opposite direction of the trend. And this is why this signal here, we have 2 if statements. The first one is if we have a downtrend, we're looking for candles going upwards, meaning bullish candles. And if we have an uptrend, we are looking for bearish candles, 4 different bearish candles going in the opposite direction of the current trend. And we want at the same time that the current candle, which is tested right here, would be in the same direction of the trend. So we have previous candles going in the opposite direction of the trend, and the current candle is along the trend. In this case, we are going to return 3 different values for this signal, the price signal, which is 1 if we have a downtrend, 2 if we have an uptrend, and 0 if we have none or we don't have this particular signal. And the signal is going to be added to our data frame under the column DF price signal. And now we can clean our data frame from non-numerical values, reset our index, and proceed to our total signal, which will be our buying or selling signal, mixing up or taking into account the 3 previous signals that we have just described. So for each candle, we're testing the EMA signal. If it's 1, meaning we have a selling signal, the prices or the candles are trading below the EMA, the 200 EMA curve. At the same time, if the volume signal is equal to 1, so we have the current candle's volume is greater than the previous candle's volume, and at the same time, the price signal is equal to 1, it's showing 4 candles that are bullish going against the current trend, and the current candle is going along the trend, meaning it's a bearish candle. In this case, our total signal is a selling signal, and the opposite is true. So when we have all the opposite values here, so we have an uptrend, we have also a volume equal to 1, and the price signal equal to 1. In this case, we have a total signal that is equal to 2, which means a buying signal. This total signal is going to be also added to our data frame under a new column called tot signal, just like that. Then we clean and we reset our index of our data frame. At this point, we can start visualizing our signals on a chart just to check if our code is working properly. So I'm going to define a new function called point position. We have used this function previous times in previous videos. It's simply to add points on the chart that we are going to plot, and the points are going to be added above the current candle if we have a selling signal, and below the current candle if we have a buying signal. Otherwise, we have no position, no particular positioning for the signal point. And to plot, I'm going to use plotly module, and we're going to choose a slice of our data frame because it would be too cumbersome to plot the whole data frame. We're going to add the EMA that we are using on our chart, and we're going to add the signal points positions. We're going to name these as signal, and this is what is showing here. This is one slice of our data frame. So we have an uptrend that is clear. The candles are trading above our 200 EMA curve, and these are the signal points that were generated by our algorithm. At this point, we can verify if things are working properly. I'm going to zoom in to one of those signals. So we are in an uptrend. We are looking to a bullish candle, this green one right here, preceded by 4 different candles going in the opposite direction of the trend. At the same time, I couldn't plot the volume here, it would be too cumbersome, but we have a higher volume. We can verify this by printing this particular candle. So it's the candle number 676. And if we print this, df dataframe.ilock index lock 674 up to 677. So I'm going to print the candle 676 has a volume 1.661026. So it's less than this one, which is in the opposite than what we wanted. But I also added for this volume signal something to increase the number of signals because I had 2 little signals at the first trial. I also added that if the previous candle has a greater volume than its previous row -2 candle, then in this case I'm going also to return a proper volume signal that is equal to 1. And this is what happened here. In fact, this particular candle doesn't have a greater volume than the previous candle. However, its previous candle, the 675, has indeed a greater volume than the 674 index row or candle. So in this case, we have a volume that is valid, a volume signal that is valid. This is what happened here. So we can look to other signals. Here we have the 850. And here also it's the same case. We don't have a greater volume for this particular candle than the previous candle. So we have 850 is 507,333. Here we have 507,6 something. But this one, the 849, the previous candle, has a greater volume than its previous 848 candles. So this is why we triggered this volume signal for the 850 candle. I just had to do this trick here to enhance the volume signals because at first, if I don't do that for the volume signal, I added this part here. So if you don't want it, you can just stop it, but we're going to have very few signals. It's not enough to build a trading system. Anyway, at this point, I can say that the code is working properly as intended, at least, and we can start setting our stop loss values. So the stop loss, I added this to our data frame because I needed to use something different this time than the previous videos. In previous videos, we always used the ATR related stop loss or fixed distance stop loss or even a trailing stop loss. In this case, wanted to do something different. I'm going to check the 4, let's say, different candles that are preceding the current candle. If I'm triggering a buying or a selling signal, let's say it's a buying signal in an uptrend, for example, this here, I'm going to check the minimum low of the 4 or among the 4 previous back candles. And in this case, this would be our stop loss. If we are in a selling position, in a selling trade, in this case, the stop loss will be the highest high among the 4 previous neighboring candles. And I'm also including the low and the high of the current candle as well. So if we look at the graph here, for example, this particular signal is a buying signal. So I'm going to look to the lowest value among this candle, the previous 4 candles, and that would be our stop loss. So my stop loss is going to be right here for this particular trade, which happens to be a great and excellent trading position. If we take this as a buying position, as a buying signal, if we put the stop loss right here after the candle is closed, and if we take another example, for example, when this candle is closing, if we execute the buying position at the top or the closing price of this bullish candle, in this case, the stop loss is going to be at the lowest point of this candle, so it's going to be right here. Then we can see that the price is increasing without touching the stop loss. So here also we have another interesting trade. And now we can start backtesting our strategy. I'm taking a 20% lot size at first. I'm using the stop loss, ATR related stop loss and take profit values. The stop loss is going to be 4 times the ATR distance, and the take profit stop loss ratio is set to 1.5. Then I'm going to run this and we are going to get 194% as a return. Remember, I'm using a margin here. I'm using 1/50 as a margin. Our win rate is around 60%. So we have 61% right here. So it's not as bad. But the number of trades is 13. So remember, we are running on a data frame of around 18 years of data, and we only got 13 trades. Let's take a look at the equity. So we have an constantly increasing equity. Sometimes the price is going down and up, but if you look at the trades, these are the trades that are winning trades in green here. And the size of the shapes reflecting the amount of win or the amount of losses. So this one is a big loss right here. It's a big size, 322. This one is 230. So yeah, from this perspective, it's not a bad strategy. However, we can see that it's not a frequently active signal on the market. So we have to wait quite a lot to get a trigger for a position. Now I also tried the other way, using the lowest low of the candles and the highest high as a take profit or as a stop loss value actually. So we are going to test this and we get 90% in return. Our win rate is something around 56%. Remember that the take profit stop loss ratio is around 1.5 and the equity is looking something like this. So we have an increase to up to 180%. So it's in total 80%. It looks nicer because it's always increasing if we compare it to the previous equity description. Regarding the number of trades, here we had 13 trades, while in the next one it's around 23 trades. So we have 10 trades more in this case. Now it's not as bad because even if you have very little trades and you have a good system, you can run it on different currencies and on different uncorrelated stocks. Now, although I'm not a fan of scalping and I'm not a fan of fast trading, I usually go for the daily charts, the daily time frame or the 4 hours time frame. This one is kind of too slow for me. I mean, if we are getting around 20 or 10 trades per 18 years, it's not much. It's like, let's say around an average of a trade per year. It's really too little. One more thing is that even we backtested this, I'm not very much convinced, because in order to properly backtest a strategy, you need to test it on, let's say 50 to 100 trades. And these here, if we are testing this on 10 or 15 or even 20, 23 trades, it's not enough to confirm the profitability of such a system. Now, the reason I was testing this is that I saw this strategy advertised as one of the safest strategies, and I was really curious to know what it would provide as a result, because I'm really a fan of conservative and very safe systems. I don't like gambling on the market. I really like it to be firmly tested and very sure, somehow minimizing the risk. If you are intending on running this on the 4-hour charts or the 1-hour charts, you can try it, but at the same time you need to keep in mind that you have to tune all the parameters, starting with the EMA length, the back candles that you are going to consider, the volume signal, back candles, and so on and so on. So you have to go through all of this and check how to set also your stop loss and take profit ratios, because these might be changing according to the time frame. I also tried this on stock markets, but again, the same problem. It needs to be tuned. Some parameters should be fine-tuned to fit with each of those markets. I simply kept these lines here commented for you, just if you wanted to test and you are curious to test this on a different time frame or for different markets. And that's all I had to tell you for this video. I hope you guys are finding these videos helpful. If so, give a like, subscribe, drop a comment if you have any idea. So until our next video, trade safe and see you next time.